There's a federal dashboard tracking every credit application in America, and it's been running quietly for years. It's not run by a bank. It's not run by a bureau. It's run by a federal regulator, and almost nobody outside the industry knows it exists. Here's what that actually means for you. In plain terms, every time you apply for a mortgage, a credit card, an auto loan, or a student loan, that application activity feeds into a federal system built to monitor the entire lending market in real time. To understand why this exists, you need to understand what regulators are actually trying to solve. A regulator's core job when it comes to lending is making sure credit markets function fairly and don't quietly build up hidden risk the way they did before the 2008 financial crisis. The problem is, without aggregated data, a regulator can't see patterns. They can see individual complaints, individual lawsuits, individual bank exam results, but not the shape of the entire market at once. The Consumer Financial Protection Bureau built a tool specifically to solve that visibility problem. It's called the Consumer Credit Trends Dashboard. Put simply, it's a federal tool that tracks loan originations and credit inquiries across 4 major lending categories: mortgages, credit cards, auto loans, and student loans, updated on an ongoing basis. Here's where it gets more specific to how this actually works on the data side. An origination is simply the technical term for when a loan actually gets issued, the point where an application turns into an actual funded loan, not just a request. An inquiry, by contrast, is what gets logged when a lender checks your credit file to evaluate an application, whether or not that application ever turns into an actual loan. Most people hear this term and move past it. Don't. The distinction between an inquiry and an origination matters because it lets regulators see not just who's getting approved, but the full funnel. How many people are applying and what fraction of those applications actually convert into funded loans. This connects to something we've touched on before regarding how lenders process applications individually. This is that same data, aggregated at a massive scale, specifically so regulators can watch the market as a whole instead of one file at a time. Strip away the banking language and here is what is actually happening. Every individual credit decision made by every lender in the country is quietly becoming part of a much larger, anonymized dataset that federal regulators use to watch the market's pulse. Here's why that aggregation actually matters in practice, beyond just being interesting to know about. The CFPB uses this data specifically to warn of potential problems in a given market before those problems become a full-blown crisis. Think about how the 2008 mortgage crisis unfolded. Individual bad loans existed for years before anyone realized how widespread the underlying risk had become because no single institution had visibility into the full national picture. A tool like this is built to catch that kind of pattern earlier, a spike in a specific type of risky lending, a sudden drop in approval rates for a particular group of borrowers, or an unusual concentration of originations happening in a way that signals emerging risk. Now here's something worth sitting with for a moment because it reframes how you should think about your own credit applications. Every time you apply for credit, you probably think of that moment as a private transaction between you and one specific lender. In one very real sense, that's still true. Your specific application details aren't published or personally identifiable in this dashboard. But the aggregate shadow of that transaction, the fact that an inquiry happened in your general demographic and geographic category for that type of loan, at that point in time, becomes part of a running national data stream the moment it happens. Let's get specific about what the dashboard actually tracks, because the categories themselves tell you what regulators consider important enough to watch continuously. For mortgages, the tool tracks how specific groups of consumers are faring in the housing finance market over time. Approval trends, origination volume, and shifts across different borrower segments. For auto loans, it tracks originations used to finance new and used vehicle purchases, giving regulators a real-time read on how accessible vehicle financing is across the market. For credit cards, it tracks open-end lending used for purchases and cash advances, the revolving credit category that makes up a huge share of everyday consumer borrowing. And for student loans, it tracks closed-end education financing, which matters enormously right now given how much has shifted in student loan reporting and repayment status over the past few years. Here's the part that's easy to miss in most coverage of this. The CFPB doesn't just publish this data and walk away. It explicitly states that these dashboards exist to analyze the effects of the CFPB's own rules, meaning regulators are using this exact same data to grade their own policy decisions after the fact. Put simply, when a new lending regulation goes into effect, this is one of the tools regulators use to check whether that regulation actually changed market behavior the way it was intended to. There's a transparency angle here that's worth understanding too. Unlike your individual credit file, which only you and specific authorized parties can see, this aggregated dashboard is publicly accessible. Anyone, Haas, a journalist, a researcher, a competitor bank, or UE can go look at the same market-level trends the regulator is watching. Here's why that transparency matters structurally. Most of what we cover on this channel involves systems operating entirely behind closed doors. Internal scorecards, secondary bureau data, proprietary risk models that consumers never get to see. This is the rare exception, a genuine public window into aggregate lending behavior, published by the regulator itself. That doesn't mean it's simple to interpret. The data is aggregated and anonymized specifically so no individual consumer can be identified, which means it's built for spotting market-wide patterns, not for checking on your own specific application. So here's the full mechanic, start to finish. The CFPB built the Consumer Credit Trends dashboard specifically because individual lending decisions, viewed one at a time, hide market-wide patterns that only become visible at scale. It tracks originations and inquiries across mortgages, credit cards, auto loans, and student loans, distinguishing between applications that get approved and funded versus applications that simply generate an inquiry. Regulators use this aggregated view to watch for early warning signs of market-wide risk and to evaluate whether their own rules are actually changing lending behavior as intended. Unlike most of the systems covered on this channel, this dashboard is publicly accessible, a rare transparent window into a system that's otherwise almost entirely invisible to consumers. In plain terms, every credit application you've ever made has quietly become a data point in a running national picture of the lending market, one that regulators watch specifically to catch emerging problems before they become the next widespread crisis. This is one of the few places in the entire credit and banking system where the curtain is actually pulled back, and almost nobody outside the industry has ever taken a look.